Tired of looking for ways to earn passive income? The easiest way to earn passive income is buying dividend stocks. Dividends usually imply sticking to a long-term strategy, but for a change, today we will also uncover some short-term dividend strategies. Watch this video until the end to find out all 4 dividend strategies for 2023. Hi and welcome to the Gainy channel. My name is Paulina. So here are 4 dividend strategies for 2023. Number 1. Supersafe. Invesco S&P 500 High Dividend and Low Volatility ETF. It is designed to provide investors with the balance of high dividends and low volatility. This makes it an attractive option for today's uncertain market conditions. The majority of the fund's holdings, over 50%, are in sectors such as utilities, consumer staples, and real estate. The fund is primarily invested in large-cap value stocks and also has a significant presence in the mid-cap value group. The current yield for the fund is higher than many other dividend-focused funds. Number 2. Less safe but still cool. iShares Core High Dividend ETF. The fund is known for its low expense ratio, which means that more of your investment goes towards the market and less towards fund management. Low expense ratios are often associated with high returns over the long term. The companies HDV invests in are selected based on their financial health, which contributes to the fund's stability. Although it's not considered a low volatility fund. HDV has 60% of the portfolio in healthcare, energy, and consumer staples sectors. This may lead to reduced risk dispersion, especially when these industries underperform. And coming to short-term strategies. Have you noticed how those ETFs have similar sectors? Why not bet on them separately and choose the ones that are expected to be on the rise next year? That way you can earn on dividends as well as stock growth. For example, oil and gas. The recent increase in oil and gas prices has led to record profits for energy companies, resulting in a significant rise in global dividend payments to shareholders. These payments have surpassed pre-pandemic levels and reached a record high for the quarter. So this year we have several prerequisites why oil and gas prices and hence companies in this field will keep growing. Number 1. OPEC Plus is not considering increasing production for the next year. Number 2. China is lifting COVID policies and is adding up to the demand. Number 3. The US strategic reserve has shrunk to almost half compared with levels from a decade ago. Number 4. EU sanctions are estimated to reduce Russian oil export volumes by as much as a quarter from pre-war levels by February, while social unrest threatens output in places like Iraq. So if energy prices are high, profits of energy companies are high too. Dividends and companies' share prices are rising. Last year, for example, Chevron grew 56% and hit 4.97 dividend yield in 2022 and has been increasing it for 36 consecutive years, helping it to achieve the status of a dividend aristocrat. Another dividend aristocrat, ExxonMobil, grew 80% and had 5.7% dividend yield, which became the 39th consecutive year of increasing. So buying oil and gas companies or ETFs like the Energy Select SPDR fund, ticker XLE, the largest ETF focused on energy stocks, would bring you good dividend payouts as well as stock growth. However, last year our TTF or thematic trading fractional model portfolio beat XLE because unlike other ETFs, Gainy's TTFs consist of just 10-15 strongest companies within a sector, which help us outperform other funds. Explore the world of thematic model portfolios made by professionals in the Gainy app. The last great way to receive dividends is REIT. Real Estate Investment Trusts, or REITs, allow investors to earn dividends from real estate investments without having to personally purchase, manage, or finance any properties. This is achieved by pooling capital from a large number of investors, making it accessible for individual investors to participate in real estate investments. One REIT that stands out for me is Realty Income. It is a San Diego-based REIT that owns and operates retail properties under long-term net lease contracts. Realty Income's tenants are large, well-known companies like Walgreens, 7-Eleven, FedEx, and Walmart. In total, it owns and operates over 11,700 properties across the US, the UK, and Spain. It has long provided not only consistent results, but consistent monthly dividends that grow every quarter. The present dividend yield is 4.5%. Buying realty income is a bet on the end of the recession, the recovery of the economy and consumer demand, and the recovery of brick-and-mortar stores. I consider it a short-term strategy because it depends on different economic scenarios. If everything's going to be as Bank of America forecasts and the recession will end this April, then everything's going to grow. However, it could go into a different direction because in the past 2 years, the housing prices has already grown 40%, which of course affected people's budgets. If the recession happens to be longer than predicted, then it will put a lot of pressure on consumer demand, which of course drives leases of the companies that are renting property from realty income. So buying realty income is quite risky, but it could also turn into great profits. One last important thing to mention is that companies can and do change their dividend policies. So investors should be aware of this risk and monitor the dividends of the companies which they invest in. Thank you for watching this video. Don't forget to subscribe to Gainy channel and see you next time.